So great. Welcome you all once again to the second aspect of the ratio analysis. Today we are going to continue with the calculation of the ratios and to end it here and start the interpretation. For now, at the initial stage, my major concern is about how to calculate the ratios right, using the right formulas and right approach. That is the intro section. After I get a ratio great or calculated well, then move on to do the interpretation. Please and please again, this section is crucial. It's an aspect that you are going to probably work on in the exams. So kindly take notes of that. Last section, we look at the profitability ratios and we have calculated all of them. All of them are there. So today we are going to move on with the second type of ratio. We said that the ratios, we've grouped them into main categories because we won't have organization who is the best in all aspects. No. So that is the section. Great. Okay. So let's see. So today we are going to look at what we call liquidity ratios. Liquidity ratios. That's today's section. Liquidity ratios. Liquidity ratios. That's today's section. We look at the main two and then the other ones. The liquidity ratios. The first one on the list. First of all, when you talk about liquidity ratio in general, what do you talk about? Liquidity ratios talks about the ability of the organization to pay its short-term debt as and when they fall due. That is the liquidity ratios. It just measures the ability of the organization to pay its short-term debt as and when they fall due, or as and when they become what? Crystallized, or as and when they become payable. That is the liquidity ratio. So basically, that is what it talks about. Here, the liquidity of the organization is said to be good or said to be great if you have enough short-term assets. So you have enough what? Short-term assets, in which we call it current assets. So if you have enough short-term assets to cover what? The short-term obligation. Short-term obligations. Great. This is also called current liability. So basically, the liquidity ratios talks about the ability of the organization, one, to generate enough short-term assets to respond or to cover its short-term obligation. That's the current liability. We are done. That is the liquidity ratio. That's what it talks about. So basically, that is liquidity ratio. Aside the profitability ratio is one of the ratios, one of the important ratios. Aside the profitability ratios, liquidity ratio is one of the important ones. So in short, we said the liquidity ratio basically talks about your ability to generate enough current assets to cover your current liabilities. That's all. And then the current assets are the short-term assets and short-term obligations. That's the current liabilities. Basically, that is liquidity ratios. Okay. Now let's see the specific ratios that fall under the liquidity. Then we are done. The first one is called current ratio. So number one, number two, number one is the current ratio. I like this ratio. Current ratio, as the name suggests, current ratio. Current ratio. Good. Current ratio. Now, current ratio, as the name suggests, current. So it's equal to your current asset all over your current liability is to 1. Please and please again, is to 1. It's a relative measure. So for every 1 cedi current liability that you have, every 1 Ghana cedi current liability, how many current assets are available to pay? That is the current ratio. The current ratio just answer the question. Will you be able to pay your short-term debt, your current liabilities, that's the payables, as and when they fall due? Current ratio will answer yes, no, we are done. And here the benchmark or the industrial average range from 1.5 is to 1 to 2.5 is to 1. So that means if we solve and the answer is not between these two range, either the company is underperforming or performing too well. That is the interpretation. Okay. So that's the current ratio. We use this question piece limited to back it. So now I am done. Now let's go to the next one so that I will pick a question on that. The next ratio on the list under the liquidity, we call it quick or asset test ratio. I like this one. Yes, I like it. Asset test ratio. So either you call it quick ratio or asset test ratio. First, you should know the formula. Why do we call it quick or acid? We say quick because how fast can you pay your short-term debt as and when they fall due? Good. We call it quick because how fast or how quick can you pay your short-term liabilities, your current liabilities. So that's all. Using still your short-term assets. So if there's any item which you have added in your current asset, which might slow you down, kindly take it off. For instance, if you take your current asset, the composition there, 1, inventory, 2, your receivable, 3, your cash and cash equivalent, your cash. These are the major composition of your current asset. So if there's any item here that will slow us down, that will not let us pay our short-term debt very quick or fast, let's take that item off. That's all. So the formula will be my current asset less any item which is within this current asset that will slow us down. So minus what? Inventory. Why inventory? Inventory, we assume that this guy, if your payables, your creditors, they are on your neck taking their money, can you promise them that they should give you some time to go and sell your goods and come and pay them? No, they will not agree. So that's why I'm not going to include what? The inventory. Inventory will slow us down. We are looking for a quick way to pay. So that's when the customer comes, we'll be able to settle it. Then all divided by your current liabilities. Again, it is to 1. Please and please again. The is to one is a relative measure and it's part of the formula. So make sure that you bring it. Both the formula and both the answer. Here the benchmark is 1 is to 1 at least. At least must be 1 is to 1. We are done. Now why are we using acid test? We didn't say water test ratio. No, we did not say base test. No. We use the word acid. Why? No, acid, most of you are coming from science and then other various field. Acid is one of the, if I'm not one, is the most fastest reaction, right? Good. Acid is going to be the most fastest reaction. It reacts fast. So when you go to the CID or International Criminal Investigation Department or any country that is maybe detain an international criminal and they want to extract some truth from that criminal and that person is not ready to tell them the truth. Good. All what they will do is this, the military. They will just put a small stick or pen in a nice, highly concentrated acid and just dip it, just the hair of that criminal. Automatic, all the truth will reveal. From head to toe, all the truth in that person will come out. So if you use the acid to extract the truth fast, and accountant, which we say we like it. So we also go that acid test. How fast can you pay your short-term debt as and when they fall due? I'm done. These ratios are very important. So kindly, let's get them. Well, now we are just looking at how to calculate them. Today, very soon, look at how to provide the interpretation. Great. So I'll read this particular question and so Peace Limited. Question number 8, Peace Limited. So great. So Peace Limited, we need current assets. So let's go to the financial position. Current assets. Here we have to get a current asset by ourselves. What's the composition of current asset? So current asset is made up of these 3 items. Current asset is made up of these 3 items. Your inventory, your receivable, and bank and cash balances. Taking these 3 together, that's a current asset. You sum them up, you get a total current asset. Then use it for your calculation. Great. Good. Here too, the examiner assumed that when it comes to financial statement preparation, you are superb. You are very great. So it can be moving you. Like he can scatter the item for you because he's aware that you know how to prepare financial statement very well. You should know what you are looking for when the items are being scattered. Like this very one, where we have not totaled the current asset for you, you can do it yourself because you know what goes in the current assets. Great. Then what about the current liability? The current liability is also here. Liabilities, accounts payable, accruals, and debentures. You know, this debentures is a non-current liability. The rest are current. So the account payable plus the accrual will give us the total current liability. Good. So basically, that is it. Now let's continue again. So we are going to calculate this. So we will start. The years are two, right? Current year 2012, and then the previous year 2011. So in the calculation tool, this is how we want the format to be, especially the calculation. Tell us that we are calculating the ratio, so calculation of the ratio. Okay, then what goes in first? First, tell us the formula that you are using. Tell us the ratio itself. So here, let me write them here. Good. And then something like this. You are done. Okay. So first item, tell us the ratio that you are calculating. Second, tell us the formula that you are using. Then if there are 3 or more years, write it, the years here, 2012, 2011. If there are more, you just arrange them. If there are two companies, company A, company B, if there are 3, A, B, C, in that order, then you are done. Good. So first, we are calculating current ratio. So current ratio. I'll tell the examiner that the current ratio is nothing but current assets over current liability is 1. Then I'll go look for the current asset for 2012 and 2011, and then the current liability. So now be with me when we are looking for the current asset and then the current liability from the question. Now let's see. So for current assets is the combination of these 3. So here to be 147,000 plus 80,000 plus 26,000. What will be the answer? Then you put it down for us. Great. So you get something like 147 plus my 80 plus the 26,000. That'll give us 253,000, right? Good. I like that too. Someone else is ready. That's great. Okay, so that's 253,000 current assets. So I'll come and put it in, but you need to show what you how you arrive at the 253,000. Tell us how you got the 253,000. So you show working. How over there. This. So tell the examiner that you added all the 3 items there. Now let's see the next item. What about 2011? So 2011 to be 118. Down to plus 24,000 plus 28,500. So that will give us 171,000. So I'm going to keep that one also in. So 171,000. I'll bring my bucket. Don't forget that it's 1. It's 1. Now let's see. So let's go to the current liabilities. Here too, they did not demarcate or separated the current liability from the non-current. So we have to know which of these items comprise of what? The current liability. Under normal circumstances, the examiner will just sum everything, so you just have to pick. But this question said no way, because you've done financial statement preparation before, we have to give you the breakdown. So kindly put the two together. Current liability is made up of the account payable and the accruals. So for the first year, 2012, I'll get something like 63,000, right? So the first year is 63,000. All right, here 63,000. Second year will be, then the second year I'll put 46,500 for the second year. I like that too. So 46,500. So the answer, I'll put it down. Please and please again, the answer must be on the same line. So 253,253 divided by 63. That will give us 4.02:1. So the answer will be 4.02:1. It's a relative measure. I have to see the 1. Oh, is to 1. Then the next one is 171 divided by 46.5. That's 3.68:1. So 3.68:1. Good. You are done. Here, if they don't give us the industrial average in the question, we can assume the benchmark to be what? 1.5:2.5. This is a meaning. If you don't get 1.5, you are not doing well. So like you are getting 1.2. No. You are not doing well. That's a bad performance. Yeah, even though the higher the better, the reverse is true. The higher the better, but there's a range. Before you can tell yourself that you have a strong liquidity or a good liquidity position, at least your current asset should be 1.5 times your current liability. So that one you can say it's 1.5 or up to 2.5, 2.5. So between this range, you are okay. When you sleep well, good. But below 1.5, no, they just don't. Above 2.5, you are doing too well. That's also a bad sign. Why should you have more current assets than you need? Why do you have short-term assets more than you need? Good. That one is a sign of what you are doing too well. Like this company, they are having 3.64. They are doing too well. Too well. You are doing too well. It's also a bad thing because you have more than what you need. Your current asset is 4 times your current liability. Oh, that means when it comes to critical, you can pay your current liability like 4 times. No. Why can't you invest or adopt what we call efficient working capital management or policy to address this? But in the interpretation that we started with, okay, I'll go to my quick or asset test ratio, so quick ratio. Quick ratio. Now, we said the quick ratio talks about how fast, if there's anything, take it off. So it's current assets, and it's your inventory, all divided by your current liability, still is to what? 1. The is to 1 is a relative measure, which must be part of the formula. Now, current asset and current liability, all of them are there. So I'll record them first before going to look for inventory. If I go, I don't see inventory, at least I've done something. They should consider me than empty. So I record current asset is 253,000 minus inventory. I don't know, so I'll bring it later. Current liability is 63,000. I'll record it. Each one, I'll put it down. So if I go to the question, I'm just going to look for inventory. This is not the time I should go and look for current asset, current liability again. No, I won't do that. Time is not there. Good. Okay. So when I come to 2011, I'll have 171,000 minus the inventory, all divided by 46,500 is towards 1. So let's go to the question and go and pick just the inventory. You are done. So exams, that's how you're supposed to do it. Don't go again, go look for the current asset. Where's current assets? Where's current asset? No. Don't do that. Inventory is what? 147,000 and 118,500. So 147,000. So I'll record here 147. Right, 147. Then the next one was 2011 happened to be 118,500. And here to be 118,500. We are done. Don't forget the east one. So what is the answer? What is the answer? Okay, so 1.68 is to 1. Then this one will be 1.13 is to 1. So it means that these people, all their liquidity was in the inventory, which is a very terrible signal. It's dangerous. Good. Realize that if we take inventory out, oh, you can pay your current liability 1.68 times. So when we added the inventory, we are paying 4 times. So it was the inventory that's supporting you. Out of 253, 147 is for inventory. It tells you that this company, they have a larger proportion of what? Current assets in inventory. Most of their current assets is inventory. And it's a very bad signal for liquidity issue. Why? Because if all your current assets are in inventory, it takes time for you to convert them into what? To cash. So it takes time for you to sell the goods before you receive cash. So if most of your current asset is in inventory, then it means that the ability to collect cash is not easy. It's not there. That is it. So here, even though they are doing well, there's an indication that they have a larger current asset in inventory. Then you put it there for them. Okay. So I'm done with the calculation of the current ratio. Originally, the current ratios are only 2. Originally, good. But sometimes we add the activity ratios. Some of the activity ratios, we add them to the current ratio. In fact, all the ratios of activity, the activity ratios, we have shared them. All the activity ratios. So when I go there, I will explain to you the activity ratio, we have shared them. Now, the liquidity. Another name for liquidity is the short-term solvency. Short-term solvency, that's the liquidity. Short-term, solvent. Solvent means company that can pay its debt. And you say short-term solvency. Okay, so in short while, in the short term, can you pay your debt? That is the liquidity. Good. Now let's continue the game. Okay, so now we're going to the ratio number 3. Right after the calculation, then we will start the interpretation, and that's the end of what ratio. Wow, that's so interesting. Now let's go to activity or efficiency ratio. That's ratio number 3. We call it what? Activity or efficiency ratio. That's the end. How efficient the organization deploy or utilize its resources to generate enough cash and revenue. Now, the activity ratios measures risks. We call it operational risks. It measures operational risks. Activity ratio talks about the ability of the organization to generate, your ability to utilize your assets to generate what? Cash. The ability to utilize the assets to what? One, to generate enough revenue. 2, and cash for the operations. So are you using your asset well to generate what? Enough cash and sales revenue for us? Yes. And then 3, the activity or the efficiency ratio measures risks. We call it operational risks. Operational risks. That is the activity ratio. Now, I said that the activity ratio, we've said all the ratio that are going to calculate over here, we have shared it among the first 2. If you take profitability ratio and if you take liquidity ratio, all these ratios, the ratios that fall under activity, you can sometimes see them still under profitability and under liquidity. Don't be confused, because we said that activity, how you utilize your asset to generate what? Enough revenue. Revenue is the profitability. Cash is liquidity. So if you see us sharing these ratios, don't be confused. Yes. That's all. Now let's see the actual ratios first under this. I'll talk about the cash ones first, then go to the revenue section. So let's see how best we can do this. So the very first ratio that we are going to look, digest well, is the one, the days inventory turnover period. So inventory turnover period, or just inventory turnover. In fact, inventory turnover just measure the rate or the period that takes you to finish your inventory, or when you buy item, how long does it take you to sell? That is all about inventory turnover. Or when you buy goods, how long does it take you to replace them? That is inventory turnover. How do you turn over the inventory? How do you return them back to the customers? So you acquire the goods maybe in 5 days. Within 5 days, the goods will get finished. You go for another one again. You have turned it over. You come, you turn it over, you go in that order. Now in calculation, we have it in 2 folds. depending on which one the examiner wants. But the first one is the popular one. We have it in periods. Periods. And we have it in times. All of them have a different formula. So let's see in periods. Inventory turnover days. So in period, we call it inventory turnover period or turnover days. Is equal to the average inventory all over cost of sales times 365. Please and please again, I am much concerned about the formulas. I'm begging you. Good. This is the formula, average inventory. So if you are calculating it in periods, so in periods, take your average inventory, then divide it by the cost of sales times 365. Again, how do you find average inventory? So average inventory is nothing but the open inventory plus the closing inventory all divided by 2. This is the average inventory. So open inventory plus the closing inventory all divided by 2. However, if the open inventory cannot be determined, then the average inventory is equal to what? Closing inventory. Let me repeat again. If the average, if the open inventory cannot be determined, if the open inventory cannot be determined, do not assume that it's equal to 0. No, don't try. Don't assume that it's equal to 0. If the open inventory is not given in the question, it's not given in the question, then what do? Oh, then don't worry. Then the average inventory is equal to the closing inventory. Just pick the closing inventory, use it as what? The average inventory. And I'll give you a critical example. Let's pick the question that we are solving. If we check 2012 and 2011. Let's go 2011, last year. 2011, if you go there, we can't get the open inventory for 2011. That's all. So we can't get the average inventory for 2011. So you have to use what? Just the closing inventory. We are done. Okay, now let's continue. Now, what about in times? What's the formula for times? If it's being expressed in terms of times. Now, with the days, the shorter, the better. The reverse is true. Because if it takes you shorter time to sell your goods, I think it's the best way, right? The best goods that you sell. You go and make the items now, the next day, finish, go and make another one again. So within a month, you can sell like 30 times. That's very good. So here the higher, but the west should be the shorter, the better. Then the reverse is true. Let's go to the times. With the times, just turn this formula upside down. Don't multiply by anything. But before that, let me mention one item here. Have you seen this 365? What if your periods are in months? So now what you do is by 12. So 12 if it is month. By 52 if it is what? Weeks. But mostly it's by day. That's why we calculate by what? 365. However, in the exams, the examiner might tell you the days that the company maybe 360 days. They inform you that the company have 360 days. Don't go and tell the examiner that by the whole year we have 365. No, they say this company have 360 days. Just use it. If they have not given you the company's days, then you have to assume for them that's the 365. Agreed. Okay. Let's go to the times. Times. Just turn this formula upside down. Don't multiply by anything. So the times formula will be, now the cost of sales rather must come on top. All divided by the average inventory. That's all. We don't multiply by anything. If the answer is 3, just add times to it. So it will be 3 times. If the answer is 4, the answer was 10. So that tell us that is 10 times. In times, the higher the better. The reverse is true. This is what they use in the olden days. In the olden days, the market woman, faster today got a free. I thought, okay, the whole month or the whole year, how many times you go to the market? Oh, 5 times, 6 times. We assume that the person that go to the market frequently is the person that making the money. So if the whole year you can go 3 times, someone is going 10 times. Let's take Dubai. For those of you who go to Dubai, you probably bring some goods. Or Israel, yes, and China. If the whole year you go there 3 times, and your friend the whole year you go there 10 times, how many of you making? That is vehicle. Yes. I understand that you ask me, but what if I go there and then my profit alone is over billions and his profit is around 1,000 cities 10 times? You can't even beat me, no. That's not what you're talking about. We are saying that ideally, the one that goes there plenty times is the one that's like in trading times is doing well. That's operational risk. So that means if the whole year you can just go and buy the goods 3 times, then you are facing what we call operational risks. So check your operations and mitigate the risks over there. Good. That is it. I'm done with the inventory turnover days. Good. I'm moving on to the next ratio. Please, these ratios too, they're also important. Yes, efficiency ratio, they are very important. Good. Now let's continue the game. The next ratio on the list is the receivable collection period. So receivable collection period. This one talks about how long it takes you to receive your money when you sell on credit. If this one talks about how long it takes you to sell your goods, tell you how long will it take you to receive your cash is equal to the formula. Average receivable. But here, let me put a strong here. Average trade receivable, not just average receivable. Average trade receivable, all divided by, the question is, what will result receivable? What will happen first before somebody will owe you from trading? Oh, when we sell on credit, we call it credit sales. Credit was sales times the period, 365 as usual. If it's month, 12 months. If it's day, week, 52, and then so on. Now, if credit sales is not there, then you can use what? Total sales. That's the sales revenue. Sales revenue, the one you see. If credit sales is not given in that question, then use sales revenue. But the P&L, the sales revenue that you see there, and there's no, we won't tell you cash component on the face. So in the footnote, you can tell, okay, sales is 20% cash, 80% credit. You only have to take the credit sales. Good, you are done. Here too, please and please again, the average rule applies here. Average trade receivable. So to be equal to open plus the closing. Anywhere you see average something, the rule applies. Open trade receivable plus closing trade receivable, all divided by 2. However, if the opening is not given, do not assume it's equal to 0. Instead, use the closing receivable as what? The average receivable. I'm done with this formula too. Now let's move on to the third one, and then we are moving on. Here too, the shorter the better, the reverse is true. And here the benchmark is 30 days. At least when you sell, it should take you exactly 1 month or 30 days to receive your money. Good. Now, here we use trade receivable, not account receivable. Great. We did this one in the cash flow. Let's revisit it again. In the account, we have what we call trade receivable. Maybe it is 1,000 Ghana. And we have what we call other receivable. Other receivable, maybe 500. So my total receivable is now 1,500. This you call it account receivable. It's called account receivable. So there are difference between account receivable and then what? Trade receivable. Other receivable is like someone is owing you, but that person have not purchased any of your goods, but the person is owing you. Yes. For instance, you give a loan to the person, a short-term loan, that the person will come and pay within 1 year, within 12 months. It's a short-term receivable, which is part of the other receivable. Or if sold one of your PPE, your fixed assets, your non-current asset, one of them to that person, and the person have not paid the money, it's other receivable. Why? Because you don't buy and sell PPE. So if you sell PPE, it's not sale. When you classify as what? Other. So that is it. So all receivable coming from other sales or the other income. So here in the question, if the examiner gives, normally we'll give you this, the 1,005, and then we'll tell you the footnote that included in this 1,005, 500 is for other receivable. Kindly take it off and get the trade receivable. We are dealing with the trade, not account. However, if in the question we still mention account receivable and there's no information that will help you to get the trade receivable, don't worry yourself. Just carry on. Good. Just carry on and then continue the game. Great. So basically, that is it. Okay. Now moving on. So here, the lower the better. At least it should take you shorter time to receive your money. Good. Too much of it is bad. If you are giving your suppliers, sorry, your customers short time to pay, they might not buy from you. We are done. Let's go to the third one. We call it payable payment period or creditors period, payment period. In fact, the period they can make it days old. So that payment period, collection period, turnover days. So they can add days to all of them. Inventory turnover days, receivable collection days, payable payment days. They are done. As usual, payable. Okay. Formula must be average what? Payable or divided by. Now, the first item that we need must be credit purchase. Why? Because it's the credit purchase that will result to what? Trade payable. In fact, here, let me add this. It's average trade payable. Take note. Now you know the difference between trade and account and other. Good. You can also owe someone, not necessarily that you purchase goods from that person. You have purchased what you deal in. Probably you purchase other items that you don't deal in and you are still owing the person. Good. Or you pick a short-term loan from the person. Now, credit purchases. If credit purchase is not there, is what we call total purchases. If total purchases is not there, then the last option available is what we call cost of sales. This is the issue. So if these two are not there, then use the cost of sales. We are done. If this is not there, use the cost of sales. Basically, that is it. This session is one of my strongholds, ratio analysis. Make sure that secure it, 20 marks secure. Stamp it. Good. Okay. Now let's continue the game, man. Here 2 times 365 as usual. This and then the 12. Here 2, the average payable, the rule affect this person. Here, what is the benchmark? Here, the lower is bad though. They give you short time to pay. Very bad. So here, the higher the better. The reverse is true. The higher the better. The benchmark is 45 days. So when you go and buy, and then when you sell to your customers, you are giving what? This session, you are giving 30 days. You are giving them 30 days to pay. But your suppliers, they have to give you what? 45 days, of course. Because when you buy the goods, it should take you some days before selling the goods, and then you now go and pay them back. So the benchmark is 40 days. The higher, the better. The reverse is true. Good. So basically, that is it. Okay. So as usual, we are moving on to the critical ones. Please, the formula. Know how to calculate it first. Second, the interpretation. That's all. Only 2 steps. First, calculate it well. Second, do the interpretation right. If the calculation goes wrong, what are you interpreting? So that's why you have to make sure that the calculation is okay. Good. But please, if you do have any questions, suggestions, don't let me finish you. Kindly chip them in. I'll respond to all of them. How? You do that through text at the comment section. I'll pick it up. The next item is number 4. It has so many names. I'll just write one and give you the other names. CCC, cash conversion cycle. Another name, net operating cycle. Another name, net working capital cycle. Net working capital cycle. Wow. One item. The names are many. Good. Cash conversion cycle. CCC. I like the CCC. CCC. I want to take some part of it. I write the formula down. I want to take some part of it. Going, in fact, gone. Cash conversion cycle. net operating cycle, net working capital cycle. That is it. Okay, so I think we can go. Now, this one is a bit crucial. It summarizes what we've done here. 1, 2, 3. 1, 2, 3. If you put the answers together, it will give you this. So here, we are saying that if you go and buy item, let's say I sell marker. So for markers there, suppose them. If I go and buy the marker on credit today, how long will it take me to recoup whatever I've invested in the acquisition of this marker? How long will it take me? That is what we mean by what? Cash conversion cycle. How do you convert the inventory to cash, to money? Money, rare money. I bought marker. So how long will it take me to get rare money, not marker? Because I need money, I don't need a marker. Good. So that's the cash. How do I convert? How long will it take me to convert this ordinary marker or ordinary inventory to what? To cash. That's all. So how long will it take me to convert what? My investment in inventory into what? Into cash. Tell the examiner like that to tell him that it's just measure how long it takes you to convert. So how long it takes you to convert investment in what? In inventory into what? Cash through sale. Yes. To cash through sale. That is it. Now let's look at the formula. So how long takes you to convert the investment in inventory into what? Cash through sale. You know, if you go and buy the goods, it is not automatic that as soon as you buy the goods, now money will start coming. No. Unless you sell it before you get your money. So that's why you say through sales. Because you have to sell first before the money will come up. I don't know, no money. You don't sell, no money. What's the formula? You say how long? It's a bit straightforward. It's equal to your inventory days plus your receivable days minus your payable days. We are done. Here, the shorter, the better. The reverse is true. And please, in the very first lecture, I did some analysis there. I hear time now allow us to do that analysis. So for those of you who have gone through that lecture, if you are aware about that lecture about company A, B, and C, good. So basically, that is it. Here, the shorter, the better. The reverse is true. Add the event to this. Let's add it to the receivable days and less your payable days. We are done. So critical. Let's great. Okay. So critical. Let me give you a company. Company company N and company P and company D. So that's company N, company P, company D. Let's assume that the inventory days are as follows: receivable days and payable days. Company N have inventory days of 15 days. So meaning that when company N go and buy his goods, exactly 15 days, the goods will get finished. Then go and buy another one again. But after sale, receivable, the customers also takes 45 days to pay the money. Okay, 60 days in all. Meanwhile, suppliers are giving him 30 days. Come and pay the money. So what will be the net operating cycle? So the net operating cycle is equal to your inventory days plus your receivable days plus what your payable days. So it means that 30 days. 30 days is too much. Let me make it. Let me make it 50 days. Good. Suppliers are giving a person 50 days. So that means the net operating cycle will be what? 30 days. So it will be 10 days. Now, company P. Company P. Company P2. The inventory days happen to be, let's say, 30 days. Receivable days is also 15 days. Taking 15 days. Payable, or making 45. Payable days happen to be 45 days. Wow. What will be the net operating cycle? 0. That means average, it takes the person 0 days to receive the money. When the person go and buy the goods, that day now the customer come and buy the goods now, you get the money to pay that. Let's go to company D. Assume that company D is 35 days. Here happen to be 10 days. But here happen to be 60 days. Wow, you're doing well. Here's 45. That means you get 15 days negative. So tell me, friends online, we said that the cash conversion cycle, the shorter the period, the better it is. So tell me, these 3 companies, which of them is doing well? Great. Okay, so the correct answer is company D. Why? The lower, the better. So 10, 0, and 50, which of these figures is the lower or the least among? It's negative 15. This is the interpretation. Let's start the interpretation. Company A, it takes him, sorry, company N, it takes him 15 days to sell the goods and takes him additional 45 days to receive the money. Saying, oh, it will take him 60 days to receive the cash right after buying the goods. It takes me 60 days. Meanwhile, the suppliers are giving you 50 days. Exactly 50 days. Come and pay the money. Meanwhile, you receive the money in 60 days time. So that means you have to go and then look for alternative source of what? Of financing this short-term credit. Use what you call overdraft. Go and borrow money. So this is where you use the overdraft to finance it because there's 10 days interval. You go and pay the money to the supplier, and then after 10 days, you now receive the money. That's why you use the overdraft, bank overdraft to service this short-term payment. So that's company N. So company N, it takes him 10 additional days to recoup its investment in England. Let's go to company P. 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 It will take P 30 days to sell the goods and 15 days to receive the money. So, it takes how many? It takes him 45 days to receive the money. And suppliers are giving him what? 45 days. So that they know. So does not even have a single day. I think that one is far better than you paying your suppliers 10 days after which you are going to receive your money. Then let's go to the boss, the D. D, it will take the 35 days to sell the goods, and exactly 10 days later, after the sale, you will take the money. So it take this how many days? 45 days to sell the goods. So now, so as soon as you buy, exactly 35 days, sale, gone. Exactly 45 days, money received. Oh, and suppliers say, wait, 60 days later. So you count the 60 days right from the beginning that you bought the item. So 60 days, that means you will keep the guy's money for 15 days. So anytime the net operating cycle is negative, it means that you are trading on the supplier's money. You are using your supplier's money to finance your operation, and you are the best. You have picked the item, you sold the item, get the money, and you are trading with that money for some days before going to the person. These 15 days, you can use to go and buy another goods again, come and sell and get profit on it, or go and invest it for just 10 days. Overnight placement for 10 days. That is it. So when it runs to negative, in fact, it's the best. It's the best when you're using your supplier's money to run your business. And you are trading with the supplier's money. So that's the cash conversion cycle. It's very important. I'm done. Let me move on. So I'm moving on to the last aspect of the activity ratio. Then we start the calculation. The last aspect, these are the cash items. The cash. So these are the liquidity. All these four ratios can be under liquidity. All these four ratios can be under what? Liquidity. So if you see some sections or some books adding this one to liquidity is not wrong, because we said that efficiency talks about how you generate money and revenue, and how you generate money talks about what? Liquidity. Good. Ratio number 5. Now we are going to look at the turnover. That's what we call the asset turnover or net asset turnover. Net asset turnover. Good. Yeah, net asset turnover. Just measure your ability to use the asset at your disposal to generate enough cash and sales for the organization. So net asset turnover just measure the ability of the organization to utilize its asset at its disposal to generate what? Enough cash and sales. That is all. Good, that's the net asset turnover. So looking on or depending on the asset that you have, what is the amount of sales that you can generate? That is all. That's all about net asset turnover. You can see some people, you can see a very, very big car. Take a vehicle, for instance. The car owners, you are aware. If you take a vehicle like, let's say, a bus with 30 seats and take a taxi and compare the sales. Good. So if your asset is like this, but your sales revenue is 100 Ghana, But someone's having a big asset like this. Oh, your sales is just 120 Ghana. Then this guy is doing better. This small thing can generate 100 Ghana. And you, look at your size. You are giving us 120 cities. That is the net asset turnover. It means that how you utilize your asset, it should equate to that of the revenue you are going to generate. That is all. Like just small fish in a very big ocean, or big fish in a very small pond that I cannot even tend. That is the net asset turnover. And net asset turnover, we measure it in terms of what? Sales revenue. So it's equal to your sales revenue over your net asset. Sales revenue over your net asset. Net asset. Now, net asset is nothing but your total asset. Your total asset, all minus what? Current liability. So that's the net asset. So net asset is equal to total asset minus current liability. You are done. That is the net asset. And that is the net asset. And please again, here the answer, we don't multiply by anything. The answer is in times. So if you calculate and get, let's say 3, just add times to it. So it will be 3 times. You calculate, you get 4, just add times to it will be 4 times. So net asset turnover is measured in times. So that means depending on your size, you are generating revenue of 3 times your size, 2 times your size. Oh, just 1 time your size. That one is very bad. And it's all 0, below 1. So that is it. Now the alternative for the net asset is the same as the capital employed. Net asset is the same as what? Capital that you have employed. And capital employed is nothing but equity plus non-current liability. All of this will give us the same answer. If the examiner does not tell you what to use, can you use the first one? Can you use the very first one? Then you are done. So we are done with the first shoe. So we are going to calculate this quickly using the question before us. Today is a calculation of the ratio. Calculation of the ratio. After today, any ratio question that we pick, we are doing interpretation, no calculation. Wait. Now we also have what we call net total or total asset turnover. It is the same as the net asset turnover. Good. Let me take it again. Having said this, there are so many versions of the asset turnover. This is net asset. You can also tell you that, okay, it says non-current asset turnover. You can also say that non-current asset what? Turnover. It also sales over non-current asset. You can also tell you that, okay, total asset turnover. Total asset turnover. That would be what? Sales revenue about total assets. We are done. Good. 8.1, we can also tell you, but from here going, all of them come with their formulas. And the examiner can create it for you. Expenses to sales ratio. Oh, expenses to sales ratio. So expenses to sales ratio. Okay, expenses to sales ratio. Then it should be the total expense divided by the sales. We are done. Or operating cost to sales ratio. Operating cost over sales ratio. We are done. These are the activity ratios. We are done. So here the popular ones are only 5. And then that's the end of the game. So I'll take this section off like this. We are done. These are the big five under the activity ratio. The big five. So let's go and calculate from this question. The big five. We are done. So as usual, I'll start calculation of the ratios. I'll set the tone before I go and pick the question. This question is in 2 years. So first, after the examiner, that I'm calculating ratios. I did that on top. I write the ratios here. After the examiner, the formula is very important. After the examiner, the first year I'm doing the calculation, and then the second year I'm done. So tell us the first ratio on the list. Inventory turnover days. So inventory days. Inventory days. No shortcut to begging you. No shortcut. Now inventory days, what is the formula? The formula is nothing by average inventory. But here, let me check first if I can get average inventory. You cannot get average inventory. In fact, in the question, if we ask for all the 2 years, we can't get average inventory. Even if it's 3 years, we can't get unless we give you 3 and ask for 2. Unless we give you 4 and ask for 3. That's where you can get average inventory. Let me repeat. When we ask for ratio, calculate the ratio for all the 2 years, you can't get average for the last year. 2011, no average. So as a result of that, you have to pick what we call the closing inventory, right? Instead of using the average for 2012. For 2012, you can get average. 2011, you can't get it. So in that case, all of them, you have to use what? Just the closing inventory. So right here, inventory, all divided by what? Cost of sales times 365. All divided by cost of sales. So I'll go and pick the we'll mark it for you. Yes. If I see average inventory here too, yes, we'll consider that. Good. Because that's the original formula, right? Okay. Now let's see. Now let's go to the question and pick the items. Inventory figure, I think we have 147,000 for that of 2012, 118,500 for 2011. Then the cost of sales is on top there. Cost of sales is also here. 295,000 and 227,000 is the cost of sales. So let's see if we can calculate it quickly. The first thing that I'll do is tell the examiner that the inventory figure for 2012 is 147,000 divided by cost of sales 295,000 times 100. This guy was 118,500. Times 365 will not time. That means we have 100 days there. Right. Compare operating for 100 days in a year. Okay, so times 227,000 times 365. Answer. Then you are done. Okay. Okay, so you get something like 147 over 295. So 147 divided by 295. Wow, times 365. That's interesting. 181. Let's make 182 days. 182. Why? Are you selling tractors? Or you are selling bulldozer? That takes 182 days, almost half a year. 182 days. Why? And 191. Sorry. 191 days. Why? Are you selling excavators? Or you are selling bulldozer? That takes 191 days. So it suggests that this company, they are dealing with high value items. High value. Usually the high value item takes longer for you sell. Let us know you are selling, let's say, tomato, or you are selling provisions. Normal biscuits takes 182 days before you sell your biscuits. No. Obviously that does not correspond. Provision shop, 182 days, almost half a year. No. Food, edible food item, 182. No. So it means that either this company, it appears that they are in what? Into production, production of machines, machine parts, or machine itself. Good. That is all. Okay, here. The lower the better. So even though it's going high, I think 2012, they've done a little improvement, right? That's reduced by some days. And then you are done. Go to 2, receivable days. The receivable days, down to receivable, or you can also take average receivable over sales times 365. What's the receivable figure? Let's go and pick it together to finish all the calculation. So the receivable figure is 80,000 and 24,000. That is the receivable figure, 8024. So 80,000 divided by 24,000. Then the sales revenue will be 456,500, and then 420,000. So here's 456 times 365 days, and 420,000 times 365 days. Okay, this one they are giving them shorter period to pay. So 64 days against so 21 days. So 64 versus 21 days. So at least this does increase. We are done. Go to number 3. We are calculating payable days, right? So payable days and it will be payable over the cost of sales times 365. So the payable over cost of sales times 365. So let's quickly go to the question. So that is payable. Payable, why you payable. Have you seen they said account payable, right? And account. So we have to get a trade, but there's no information that will help us to get a trade. So pick it like that. So that's 37,500 and 26,500. So 37,500 and 26,500. That is it. Okay, so we pay the cost of sales. The cost of sales happen to be in the profit and loss account. That's 295 and 237. I will use this somewhere. Oh, yes, cost of sales. And the cost of sales. So I just have to take it for it. 295,000 times 365 days all over 227,000. So times what? 365 days. Perfect. Okay. So answer would be 46 days versus 43 days. I like that too. Good. So 43 days. We are done with the payable payment days. What about the cash conversion cycle? C. Let's shortcut in the exams. Cash conversion cycle. Cash conversion cycle. So for cash conversion cycle formula. Can tell us the formula. Thank you. So inventory days plus receivable days minus payable days. We are done. So here, let's see which of the years are they doing well. Inventory days is 182 plus 64. That will give us 246 minus the 46. So that will give us 200 days. That will give us exactly 200 days. Is that true? First online, you can confirm for me. 200 days. If you want to show working, it's 182 plus 64 minus 46. And that will give us 200 days. It means that if you go and buy the item, it takes you exactly 200 days to convert. So it means that 200 days. Meanwhile, your suppliers gave you 46 days. That means you are going to pay the money 200 days before you receive the actual cash from sales, which is very, very, very bad. As soon as the suppliers, they know that they can't wait for that 200 days. So as soon as they sell the item to you, they are giving you what? 46 days. And you are going to keep this inventory for 182 days. And the customer will come and buy it for 64 days in addition, making 246 days. Then at the end of the day, on the customers will take their 46. So that means after you pay the suppliers, it takes you 200 days to receive the money. Wow. From the customers, which is very bad. Here is 169 days. Which is also bad. So that is it. Now let's talk about the net asset turnover, and then we pack the item of activity or efficiency ratio somewhere, and we look at solvency. Today is the calculation of the ratio. So kindly get the formulas correct. Again, I'm now going to look out for the last one on the list, which is the asset turnover. Now, the asset turnover can be part of profitability ratio because it measures your ability to generate revenue with your assets. So it's part of profitability. So I inform you that for activity efficiency, all its ratios have been shared among the other key ratios. So the first four that we look at for are the liquidity, the last ones under the profitability. So net asset turnover. First, the formula is equal to sales revenue over net asset. No times, nothing, don't matter about anything. Sales revenue, if you recorded this, I don't need to hear it. 456, 456, 500. I don't need to come and then we open the book again. Sales here is 420, so I record them first. When I open the book, I'm only going for net assets. I'm done. Net asset is equal to total asset minus what? Current liability. So let's pick the net asset from the question. So total asset is 369,000. What's the current liabilities? So the account payables and accruals. Good. So the net asset to be 369,000 minus the 63,000. I think the current liability, we had it from the liquidity ratio. So it was 63,000. So therefore, so 369 minus the 63,000, that'll give us, so it must be 369,000 minus 63,000. Okay. For that of the other one, that's the total asset of 308. So to be 308,000 minus 46,500. Okay, so the answer will be great. So the answer will be, the answer must be in times. Okay, so here will be 1.61 times. So this is 1.5 times. The 1.26 times. Okay, so we are done with the activity ratio. Activity ratio. It means that, right? It means that we are done. Just that this one must be 1.61, right? Times and 1.2 1.26 times. Hey. 20, 11 is 1 point. So it means that this section 1.5 and 1.61 times. We are done. Now we are done. We are done. We are going to the next category of the ratio. The next category of the ratio. The next category of the ratio will be the gearing or long-term solvency. So let's move on. So this is how you calculate your net asset. This is how you calculate the net asset turnover. Net asset turnover, which is basically the same as asset turnover. However, it's not the same as total asset turnover. I've mentioned 3 items. 2 are the same. 1 is different. Good. Let's continue the game. And everyone will be fine. We are going to gearing. Gearing or long-term solvency. Long-term solvency. We said that the short-term solvency is liquidity. How you can be solvent long-term or stability. Long-term solvency or stable. You'll be in stable business for long. Or survivor. Yes, all depend on your gear. The word gear or gearing and then the leverage in financial reporting, they are the same. So something like leverage. The word leverage and gear or gearing, they mean the same thing. Gear means debt in financial reporting, in the context of financial reporting. Leverage and then gear means debt, non-current liability. Non-current liability, that's the meaning. Non-current liability. So gear and then leverage. Now this ratio, it talks about 2 items. This ratio analyzes 2 items. 1, this ratio analyzes the ability of the organization to generate streams of cash flows. 1, how you generate what? Generate streams of cash flows. Streams of cash flows. That's 1. 2, using the cash flow for to repay back your loans or debt or to service debt. So use the cash flow to service what? Debt. In fact, it's bracket the principal and the interest, right? That's the amount. Third one, long-term survivor. That's the operations. Servicing of debt and financing of your operating activities. So financing of the operating activity, OA. And third one is a survivor. Survivor, you have to survive. Okay, so basically that's the gearing ratio. It measures risks facing the organization. It measures the risks. The type of risk is what? Financial risk. Survivor. Good. You know, some organization immediately they start paying their debt or start paying the interest, things start to shake in the organization. They will suffer from liquidity or cash flow. So which will affect your survivor. But some organization, oh, don't even affect them. Good. That is the long-term solvency or stability. And it also four measures risks, measures financial risks. Measures what? Financial risk. Anybody that is having debt, even if it's one Ghana cedi, you have a financial risk. Non-current liability. So if your capital structure you do have non-current liability, then you will face a financial risk. Financial risk is the risk associated with what? With debt. So it's like if you have a sugar cane, definitely you have what? Definitely. If you have sugar cane around you, definitely it will call for ants and then house flies, right? Good. So that's the financial risk attached to what? Attached to sugar cane. Good. If you have bones with you, definitely dogs will come around. That's the risk attached. So once you have a debt, financial risks will be chasing you. What are the financial risks? For example, the only two. Default risks and bankruptcy risks. There's a risk that you default in payment. And then the next one is what? Bankruptcy. You will be declared what? Bankrupt by a competent court. Will declare you bankrupt. And then that's end the game for you. Good. So that is it. Now let's look at the specific ratios that falls under that of this. Ratio number one, debt to equity ratio. Debt to equity ratio. As usual, debt to equity. So the formula will be debt over equity times 100. Now, when you say debt, which type of debt are we talking about? Is it a short-term debt or long-term debt? The debt that we are talking about is a non-current liability, not short-term. Times 100. Yeah, done. Yeah, the benchmark is 100%. If you calculate, you get 100%, 50-50. If you get more than 100%, the company is what? Highly geared. Because if you get less than 100, the company is what? Lowly geared. So highly geared and a lowly geared company. But once you have a debt, you're a geared company or you're a leverage company. Once you have a debt, even if it's 10 city, 1 city debt, as long as non-current liability, you are a geared company. So basically, that is it. Okay. Number two, I call it debt to capital employed, or also called small gearing. Debt to capital employed. Number call it small gearing. Gearing. So it's equal to the debt, which is the non-current liability, all divided by capital employed, which is equal to equity plus debt. So with this, the formula will be something like debt over equity plus debt. That is it. So debt over equity plus debt. That's the debt to capital employed. Here 2 times 100. Let's go to the third one. Then we add through. Please, all of this has been done in the arrangement. Now the third one is, if I hear the benchmark is 50%, if the benchmark is 100%, so take note before you go and then make a wrong statement. If I using this approach, unless you get to 50, more than 50% before you tell the examiner that the company is highly geared. If you are using this formula, you are getting, let's say, 30% lowly geared. If you get 56, let's say 60%, if you use this formula and you arrive at 60%, then the company is what? Highly geared. For this one, the benchmark is 50. However, if you use this method, and then you get 60, the company is lowly geared. It's not even up to the 100% benchmark. So take note. All of them gives us the same item. So all of them give the same item. The first two, all of them tell us the same thing. The other one is coming from different angle, other one is coming from different angle. They tell the same item, so 1 and 2. The third one is interest cover. Can also call it times interest cover. Interest cover is the profit before interest and tax all over the finance cost or the interest expense. Yet we don't multiply by anything, the answer will be in times. We are done. Okay. Basically, we are done. So we have to just back with what last question. The interest cover but that one, the higher the better. The reverse is true. It must be high. If it's too low, it suggests that shareholders' dividend is at risk. Let me add the last one to it so that we will do the calculation. The fourth one is what we call debt to asset ratio. Debt to asset ratio. Now the debt to asset ratio, can also have debt to non-current asset ratio in that order. So debt to asset ratio If debt to equity is debt over equity, debt to capital employed is debt over capital employed, then debt to asset will be what? Debt over asset. Thank you. So non-current liability is the debt all over the total asset. We are done. Times 100 because it's ratio times 100. That is it. So this one explains the proportion of the asset being financed by debt. The asset that you have, how many of them that you bought with what? With debt. That's the debt to asset ratio. We are done. Now let's back this with last question. So let's go and pick it from the question and calculate it. And then we will end there. Then you will continue with the many ones for me. Good. So let's calculate these 4 items from the question. So as usual, my table, I'm not going to leave the table. The first ratio formula 2012, 2011. I am starting with debt to equity ratio. No shortcut to not equity is equal to non-current liability over equity times 100. So let's go to the question. Let's go and pick them. So the liabilities, among these 3 liabilities, which of them is non-current? That's the debentures. So only debentures will be the non-current liability here. And which is 58,500 plus 37,000. Okay, so that's the respective years, right? Then let's see equity. Equity, you add all the 3 items there together. So let's see, that would be 58,537. So 2. Good. Let's see the equity for the 2011. Great. So we sum up 40 plus 50, 90 plus 157, right? Good. So so 2 2. 224,500 times 100. Any answer for me, friends online? Okay, so 24. So 16.5%. Now the equity, we sum up all the equity items. And equity items are the one here. We need the stated capital. So that we don't add the preference shares to it. Agreed. That's if it is redeemable preference shares. Good. But this one is not a redeemable preference shares. If it is redeemable preference shares, it will be part of the non-current liability. If it is irredeemable, it must be part of equity. So basically, it's correct. It's irredeemable, which is equity. So it's correct. So it's made up of these three items. Put them together. So equity is made up of, for 2012, to be 40 plus 90 plus 157, 500. And that is the end of the game. Okay, now let's continue the game. Number 2, debt to capital employed. So now current liability over equity. That's non-current liability.
So the non-current liability for the first one is 58,500.
Okay, so 58,500.
Divided
37,000.
the equity is 247,500 plus the debt of 50. Hello. 247,500.
Good. So basically, we do have the items here. So debt over equity 247,500 plus the debt again 58,500. Then like this times 100. Agree. So it should be something like this. 58,500 all divided by 247,500 plus 58,500 times 100.
About 19.1%.
Perfect. So 19.1%. We come here. In fact, I have to show the markation to them. You have 37,000 all divided by
224,500 plus 37,000.
Good. .1%. So now let's go to calculation number 3. Okay, so the next one is interest cover. Have you seen here the benchmark is 100%, right? So it's lowly geared, it's not highly geared. Yeah, the benchmark is 50%, still lowly geared, lowly geared. So take note. Okay, so I'm going to cover the remaining two, then we'll end for the calculation of the ratios. What's left with the investor or the market position? Great. So still, interest cover. Interest cover. Formula, profit before interest and tax all over the interest expense. The answer is in times. And this profit before interest and tax, we calculated it in the very first video. So pick the answer from there, then move on. Good. So we say if you're going to get the profit before interest and tax, just pick the profit before tax and add back the interest. Profit before tax is what? 42,500 plus the interest, 14,500. That'll give us a profit before interest and tax. So 42,500 plus 14,500. 42,500 plus 14,500. That's the profit before interest and tax. All over the interest expense, that's the finance cost, 14,500. You are done. Perfect. So that's 57,000. I like that too. Then I did the same thing for that of the 2011. 2011 will be 101,500 plus 3,000. So 101,500 plus 3,000, all divided by 3,000. Answer is in times. What will be the answer? Then we are done for the day. Rest, yes. Okay, so 57,000 divided by 14,000. 57 over 14 should give roughly 2 something. Okay, so we get something like 57 divided by 14.5. That's 3.9 times. The answer is in times. So 3.93 times. I like that too. So this one with 3.93 times, please. Add the times to it. 2011 will be 3.4 times. Have you seen how we have arranged it? The same way in exams, you have to also arrange it. Then I'll come, the last one. The last one is debt to asset ratio, which is equal to the non-current liability over total assets times 100. You can also have debt to non-current assets ratio. Let's assume that's non-current. Okay, we'll do that one later. The non-current liability is the 58,500. Yes. All divided by total asset. What was total asset? total assets is equal to total assets. Why? Total assets 369,000. So 369 times 100. The debt over here is 37,000 over the total assets of total assets of 308,000. 308,000. Oh, this one is not going on. 308,000 times 100. We are done. So answer, and you will try the debt to non-current asset ratio. Okay, so let's see. So this one is 34 times. It's 34 times, not 3.4 times. Okay. 34 times. Wow. That means your profit can pay your interest 34 times. Oh, then you have a very nice insurance cover. Okay, so that is it. It's 34.8. So that means it should be 35 times. So 34.8 times. 34.8 times. Now let's work on the debt to asset ratio. And let's see. So this divided by 369. That's 15.85%. So 15.85%. It means that 15% of the asset was financed by debt. 2011 will be 37,000 all over 308.
12%.
So that's 12%. That means 12% of the asset was financed by what? By debt. Now you can also have debt to non-current asset ratio. Who will tell me the formula? Debt to non-current asset ratio.
Debt divided by non-current assets.
Debt to non-current asset ratio. So that one is debt over non-current assets. And that's the end of the game. Okay, so on that note, we'll call it successful meeting. Now I'll give my trial. What level is the investor or the market position ratio? And for that one, we are going to use the next lecture video to look at it. We have to look at that one all fully. So take note. We are still at the calculation of the ratios. Still at the calculation of the ratios. Great. Now let me give you a trial work. You are doing diamond and shine. I need all the ratios, including the investor or the market position. All the ratios calculated. All. So let's go to question 8. No question 8 too. It's not question 8. That's question 3. I need all ratios. You are starting from gross profit margin down to C, return on equity, all of them for this particular question, diamond and shine. Diamond and shine. That's what I want. Here, forget about the requirements. You are calculating all ratios that you've calculated so far. plus the investor ratios. Obviously, they've given equivalent here. Go ahead. Don't follow this equivalent that they've given to us, but follow what we have. Calculate all possible ratios. All possible. So you are learning how to calculate ratios first before you come and do the specialization. Good. And you'll be fine. Now, the investor ratio, we're not coming back to it again because it is in one of the lecture video. And then the one that I posted on the platform contains investor ratio. So kindly use that one for me and then you will be fine. So on that note, this is how far the good Lord will bring us. Kindly subscribe to the channel if I've not done that and follow to the next level. Good.